Welcome to the fixed income outlook for the month of May. The war is going on and the oil prices are high. There are some questions. Let me address them one by one. The impact on the economy so far has been muted. And the reason is that the pump prices have not been increased. The pump prices are still around 100 rupees. There have been some increase in some chemical prices, in the availability of gas, but that has not impacted economy largely. As far as the economic momentum goes, the economic momentum continues to be positive. And that can be seen in a lot of areas, whether it is two-wheeler sales, whether it is cement demand or steel demand or the power demand. The economic momentum continues to be positive. And that's a good news for the country. The answer to this question lies in the balance sheet strength of different sectors of the economy. The government sector, the private sector and the household sector. Because the buffers built in each of these sectors would decide how long can we take the pain of elevated oil prices. Right now, most of the pain has been taken by the government sector and the oil marketing companies by absorbing the losses in their balance sheets. The good thing is the starting point with the government is good, given that fiscal consolidation has happened in India over the last 3 to 4 years. This gives room to the government to absorb some of these losses. The other is the government can also switch expenditures by cutting some of the expenditures which can be deferred and including oil subsidies within the fiscal calculations. Oil marketing companies can also absorb the losses by taking in debt for a period of time. Lastly, household sector has not seen change in pump prices for a decently long period of time. So there is capacity to pass on some of the prices to the household sector as well. The three combined can sustain oil prices impact for some period of time. However, this is if oil prices remains around $100 a barrel. If the oil prices have to go significantly higher, then the capacities will get challenged. And India's ability to grow and continue its macro stability will get questioned. But at $100 of oil, I think India will be able to sustain both its macro stability and continue to grow well. As we spoke last month, RBI has time on its hand. And I don't think that RBI is pressed to change interest rate direction because of this one-time increase in oil prices. And the reason is that the last 2 years of low inflation is helping contain inflationary expectations at this point of time. There are two reasons why yields are high. One is, of course, the war premium, which is overlaid as a risk premium on the yield. And the second is the underlying demand for deposits as the banks continue to grow aggressively. Once the war ends, the risk premiums will go off, but the underlying economic growth trend will continue to push yields high. So therefore, while we are tactically positive on the long end of the curve with a view that risk premiums will go off, we structurally like the short end of the corporate bond market. We like the ICICI Prudential corporate bond fund, the short-term plan, the banking PSU debt fund and the floating rate fund. We also like the gilt fund and the all-season bond fund. We are tactically positive on the gilt segment as well. The yield on the SDLs and the long bonds are close to the previous cycle peaks, which make them a compelling tactical investment at this point of time. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.